So in the last section, we use Claude AI for Excel to build a settlement level commission and funds withheld table, calculating the ratio of withheld funds against total commission earned, flagging the settlements where that ratio exceeded 50%, and then producing a portfolio level interpretation of what that means for net settlement exposure. That gave us a clear answer to the fourth question. If you operate under a funds withheld reinsurance treaty, are you tracking commission and retained premium movements alongside your claim payments in the same breath? Now I want to move to the fifth question, and this one sits squarely in the territory of regulatory reporting, which is an area where precision is not optional. The question is, when your regulator or your auditor asks you to split loss payments from loss adjustment expenses, how quickly can you produce that? Let's find out. But first, let's start with a question that sits right at the intersection of regulatory compliance and data, and one that the data, if modeled correctly, can answer definitively. In insurance, there are two fundamentally different types of payment that come out of a claim. The first is the indemnity payment, the amount paid to compensate the policyholder for their actual loss. The second is the loss adjustment expense, the cost of investigating, managing, and settling that claim. In everyday conversation, people often refer to both of these loosely as the claim cost. But under IFRS 17, the international accounting standard that governs insurance contracts, and under Solvency II, these two components must be reported separately. And for Lloyd's Syndicate Business Forecast submissions, the split between indemnity and loss adjustment expense is a required disclosure, not an optional one. If you cannot produce that split cleanly from a single reliable source at any point in time, you have a reporting problem. And in my experience, the reason most businesses struggle with this is not that the data does not exist. It is that the data has not been structured in a way that makes the segregation automatic. In a well-engineered data model, that segregation is already built in at source. Paid claim and outstanding represent the indemnity side. Paid fees and outstanding fees represent the loss adjustment expense side. Every transaction has been flagged before it ever reaches a report or a dashboard. And that is the data engineering doing its job quietly in the background. And in the next two prompts, I'm going to show you exactly what that looks like in practice and why getting that engineering right is what makes everything Claude AI for Excel produces completely reliable. So, you should by now be very familiar with this table, and by this point in the series, you will recognize immediately which columns we are working with. Claude AI is open here in the panel on the right. The first thing I want to do is look at fee loading settlement level. Fee loading is simply the ratio of fees to the paid claim. It tells you, for every pound paid out in indemnity, how many pence was spent managing and settling that claim. And where that ratio is high, above 20% is the threshold we are going to use, it flags settlements where the cost of handling the claim is disproportionate to the loss itself. That kind of outlier has several possible explanations. A complex disputed claim with heavy legal involvement, a high-value loss adjuster engagement on a relatively modest loss, or simply a data quality issue, a fee that has been posted against the wrong settlement. Whichever it is you want to know about it, let me type the first prompt. For each settlement ID, calculate the fee loading ratio by dividing paid fees by paid claim. Highlight any settlements where fees represent more than 20% of the paid claim amount as outliers for review. So, here is the fee loading table. Every settlement with a calculated ratio sitting alongside paid claim and paid fees, and the outliers clearly flagged. Now let me just draw your attention to what this list actually represents in a business context. Each flagged settlement is a question that your claims management team needs to be able to answer. Why did it cost this much to settle a loss of this size? Is this consistent with the type of claim? Is the fee structure aligned with what was agreed with the loss adjuster or legal panel? These are not difficult questions to answer. once you know which settlements to ask them about. Before this prompt, finding those settlements would have meant building a calculated column manually, applying a filter, and cross-referencing a separate fees schedule. We just did it across 2,000 rows in one prompt. And that flagged list is also directly useful for your claims handling expense analysis, a key input into pricing and reserving models for any specialty insurer that wants to understand the true all-in cost of a settled claim. Now let's move from the settlement level to the regulatory level, because the fee loading analysis gives us an operational view. It tells us where to look for anomalies. What I want now is a disclosure-ready summary, the kind of table that feeds directly into a regulatory return or an IFRS 17 reporting pack. Specifically, I want to see total paid claim, paid fees, outstanding, and outstanding fees as separate line items formatted as an indemnity versus loss adjustment expense split. Let me type the second prompt. Produce a regulatory summary table showing total paid claim, paid fees, outstanding, and outstanding fees as separate line items. Format this as an IFRS 17 disclosure-ready split between indemnity and loss adjustment expense. And there it is, a clean, 4-line regulatory summary table. Indemnity side, total paid claim, and total outstanding, representing the actual loss payments and the reserves held against future payments. Loss adjustment expense side, total paid fees and total outstanding fees, representing the cost of handling those claims and the reserves for fees not yet invoiced. This is the exact structure required under IFRS 17 for insurance contract liability disclosure. It is also the structure your Lloyd's SBF submission expects when you are reporting claims development by component, and it is the structure your external auditor will want to see reconciled back to your general ledger at year-end. What would normally require a finance team to manually aggregate figures from multiple system reports, apply account code mappings, and format the output to a specific disclosure template, we have just produced in one prompt, directly from the source data, with the indemnity and expense split already applied. 2 prompts, a flagged fee loading analysis for claims management and a disclosure-ready regulatory summary for finance and reporting. Let me pause here because it is worth being clear about what we have just demonstrated. Fee versus loss segregation sounds straightforward in principle. Separate the indemnity from the expense. But in practice, across a large portfolio with hundreds of transaction types, posting codes, and account classifications, maintaining that segregation cleanly and consistently at source is genuinely difficult. We have just produced a flagged fee loading analysis and a regulatory disclosure table from 2 prompts in Claude AI for Excel. Next, we move to the final section, downstream analytics and portfolio reporting, where we bring everything together into a single executive view. But first, a quick word on what is sitting underneath all of this. None of this works unless paid claim, paid fees, outstanding, and outstanding fees have already been correctly separated in the data model. That separation is not cosmetic, it is structural. Underneath everything Claude just produced, a data engineer has applied the ISFI flag at transaction level, consistently, across every single posting. That flag is what separates a fee from a loss at the point the transaction is recorded, not at the point of reporting, not at the point of prompting. At source. Without that flag being set and filtered correctly, the fee loading ratio measures the wrong thing and the regulatory table discloses the wrong figures. The output looks clean, the numbers are not. The data engineer ensures that never happens, maintaining the separation between fee transactions and loss transactions across every account type and every posting code in the system, long before anyone opens Excel. Once that engineering exists, Claude AI can turn it into a disclosure-ready regulatory summary in one prompt. The speed is Claude's. The accuracy belongs to the data engineering underneath it. That is the combination this channel is built on, and that is why data engineering is never the optional part. Before you go, everything you have just seen is available for you to use right now. Click on the link in the description and you'll get the exact prompts I used across this entire series, word for word, covering claims reconciliation, co-insurance apportionment, trust account monitoring, funds withheld tracking, fee segregation and portfolio reporting, so you can run the same analysis on your own claims data without starting from scratch. You'll get the data model that sits underneath it all, the structured claims view that tells Claude AI for Excel exactly what every field means, from paid claim and outstanding through to the apportionment and trust account fields, and why every number it produces can be trusted. You'll also get the dataset itself, 2,000 settlements of precisely modeled claims data, so you can see the outputs before you ever connect your own systems. Everything is in the description. One click, no cost, just the tools you need to make sure your claims data is always telling you the truth.